Here's a question I couldn't answer about my own practice last month. What percentage of our total work output was handled by AI versus humans? Not we use AI tools. I mean the actual discrete steps it took to close a client's books, prepare their year end, process their tax return. How many of those steps were executed or drafted by AI? And how many were done entirely by a human? I have no idea. And I bet you don't either. That's not a minor gap. When AI categorizes a month of bank transactions and your team member reviews the output in 20 minutes, whose utilization does that count against? Traditional metrics have no category for work performed by non-humans. The most productive part of your organization doesn't show up in your management data at all. And here's the thing. The KPIs that built successful accounting firms, utilization, average hourly rate, profit per partner, revenue per FTE, those aren't wrong. They've guided firms for decades. But they were built for a specific model. Humans doing the work, tracked by hours, billed by time or fixed fee. Every ratio assumes human labor is the production input and the scarce resort. But that model is changing, and nobody's updated the dashboard yet. Think about it this way. Utilization measures whether your people are busy. It doesn't measure whether they're busy with the right things. A firm where everyone runs at 75% utilization, doing work AI could handle, isn't efficient. It's burning human capacity on tasks that don't require human judgment. You'd never know it from the dashboard. The traditional metrics assume the constraint is hours. The levers are clear. Price higher, get more efficient, reduce partner time, increase leverage through headcount. But in an AI-first firm, the constraints shift. Hours aren't the bottleneck anymore. Judgment quality is. Capacity doesn't scale by hiring, it scales through better AI deployment and better knowledge systems. So I've been building systems to track how work actually moves through my practice when AI is involved. 3 measurements kept surfacing as genuinely useful. And I want to put them out there, not as finished answers, because I haven't got it right yet, but as a starting point for what the profession needs to figure out together. So the first one I'm thinking of, AI task coverage. What percentage of your total work steps are handled by AI versus humans? This is the adoption gap made visible at the firm level. You deployed AI tools 6 months ago. If this number hasn't moved, your investment isn't changing how work gets done. It's just another subscription. Track it by service type, and you'll see where AI is actually embedded in operations versus where it's still sitting on the shelf. Second, first pass accuracy. When AI produces a draft, or a transaction, or a reconciliation, a work paper, how often is it accepted by a reviewer without modification? This measures something most firms never think about: the quality of the knowledge systems you've built around AI. Your SOPs, your client profiles, your encoded decision rules. If first pass accuracy is improving over time, your AI is getting smarter about your specific practice and clients. If it's flat, you're getting the same generic output you got on day one. You haven't built the context that makes AI genuinely useful. And third, human judgment concentration. Of all the hours your people work, what percentage is spent on activities that genuinely require professional judgment? Not data entry, not report formatting, not reviewing work that AI could have done. Advisory conversations, complex exception handling, relationship management, strategic analysis. This metric tells you whether your team is spending time on what's actually irreplaceable or whether they're still buried in the commodity layer. Now, let me be precise about what I'm not saying. Profit per partner still matters. AHR still matters. Utilization still tells you something useful. The economics still have to work. That hasn't changed. But these 3 metrics answer questions the traditional dashboard can't. You're managing a 2026 firm with 2016 instrument panels. The firms that figure this out first, that develop the right measurements and the right management practices for an AI native model, they'll have an enormous advantage. Not because they adopted AI earlier, but because they learned to manage it better. Now, I don't have this figured out yet. I'm still working on it. I'm still building systems, testing measurements, learning what actually moves the needle, and I can't track most of this yet. But the profession needs to develop a shared language for what matters in an AI-forward firm. The same way benchmark frameworks gave us a shared language for traditional firm performance. So I'm just putting this out there as an opening contribution, not a finished answer. I want to know what you're tracking, what you think I'm missing, where you think I'm wrong. If these metrics resonate with your experience, or if there's something more fundamental you haven't considered, I'd like to know about it. And if you'd like to start buildings to measure and manage AI adoption in your practice, start with AI Essentials at theaiaccountant.ai, the implementation platform. It's guided onboarding, curated workflow library, and a monthly live call to work through exactly these kinds of questions. The framework in this article gets real when you're measuring it against actual work in your practice. Let's build this together. I'd love your feedback.